So, good morning to everyone. I hope you can hear me. Yes, perfect. So, today we're going to have a very big lecture. So, it is composed of two parts: options markets and option strategies. And these two lectures have a joint home task. So, this material is based on our previous group capacity. But if this time it will be if material is so difficult to understand, we will split the lecture in two parts. So don't hesitate to ask me questions. So first of all, I have to mention type of underlying assets. If we talk about options, there are single stock option, the most rare type of option. There might be an index option, so it might be S&P 500 option or VIX option, so any option on index. That's quite popular type of exchange traded options. So FX option, it's quite clear. There might be futures options and commodity options. As for futures options, there are often options on commodity futures, options on index futures, options on bonds. Bonds, but most often like T-bills, T-bonds, so there might be options on futures on treasury bills. So when we talk about futures options, in fact, this type of options cover a vast majority of various assets. But we won't focus on these tiny details. So here we've got a screenshot from the Bloomberg terminal. So here you can see a call option. So letter C implies that this is a call option. VIX US, this is an underlying. This is an index. C30, 30 means strike. Last trade, expiration. So this is May 2021, the VIX option. So what else is available here? This is a price. This is a payoff graph. Volume, open interest. Open interest is important because liquidity is somehow critical to options markets. If there is no open interest, you just can't trade this option. So that's why open interest graph is important. So this is hours, trading hours. Contract size. That's important. Periodicity of options. So here we've got breaks. We're going to talk about breaks at the end of the course, but breaks are critically important to an options trader. So that's how a call option on index looks like in Bloomberg and what route info is provided. Similar info can be received from some open sources. So if you just put in any searching system, any type of a particular option, you will be able to get basically the same type of info. And here we've got a put option. That's the difference with its payoff. And Greeks are different for sure. So, and open interest, as far as you can say, it is less liquid than call option. So compare volume, open interest, and here you can see volume and open interest. Call options are more liquid than put options, more popular. So here we've got an example of contract specification. So here you can see a contract issued by Chicago Board of Exchange on volatility index options. So what is specified in the contract? A symbol. That's first of all the most important part. The contract provides description, how the index is calculated, what is this index, what does it mean, trading hours, and so on. So description is a description of an underlying. Here we've got multiplier. That's the same logic as for futures. By what amount we have to multiply a number to get US dollars. So if I've got, on this example, 30, what is 30? 30 multiplied by 100, that's 3,000 US dollars. That's multiplier. So here we've got info on strike prices. That's a step. If the strike price is below 15 US dollars, options are offered with step with a half of a US dollar. If the price is between 15 and 200 US dollars, the strike price, the strike step is $1, and for prices above 200 US dollars, the strike price changes with 5 US dollars interval. So if the strike price is 300 US dollars, you won't be able to see any strike price like 214, 215, or 210 will be available. So the rest is premium quotation, options premium, the same, a step is given for premium quotation, expiration date, contract expiration, exercise style, European, American, Asian, Bermudian. So here we've got European option, last trading day, trading hours. This info, you can have a look at this info as soon as you get slides, but You have already received this slide, I hope. So what is important? I highlighted with yellow and red several points that are important. So this is how the VIX price is calculated. And this is what the time to expiration means, how it is calculated. So just have a look at these details. What else is important? Customer strategy-based margin. What does it mean? Customer strategy-based margin. Depending on your strategy, Chicago board requires margin to be posted. The same way as when you short an equity, for example, you have to post margin. When you trade on a futures exchange, you have to post margin. So the same thing here. Depending on your strategy, you are required to post a certain amount of money that's a guarantee that you will be that you are financially solvent. In simple words, it's a guarantee that you'll be able to pay to purchase an asset or to purchase or sell an asset. And depending on your strategy, whether you are entering a strangle or straddle or bull spread or butterfly or whatever, you have to post a certain amount of money. So that is why options trading is costly. When we use options to hedge, options trading is costly. If you'd like to trade options like on a daily basis, you'd like to make like different risky strategies. Because if you'd like to use risky strategies, you will be required to put certain amount of money as margin. So if you're interested in details or these details are important to your any strategy calculations, you can have a look at the Chicago board details. These details are given on their website. So what is important for our course is that different strategy requires margin, and hedging, fully hedged portfolio will cost you. So in theory, fully hedged portfolio value is 0 in theory. But in fact, fully hedged portfolio, if you hedge your portfolio with options, has a negative value because you pay transactions costs and you have like profit for gain because of posting margin. So if you're interested in details, you can have a look at these slides because you have already emailed these slides. So a very brief glossary how mechanics of exchange traded options. So first, strike prices. How do we get different strike prices? Is that possible to sell or to buy an option with any strike price? Well, in fact, it is not possible to purchase an option with absolutely any price. Because when a new expiration date is introduced, there is a certain range of strike prices closest to a current stock price are selected by the exchange. If the stock price moves outside the range, a new set of strike price is introduced. So If the current asset price is 10, that's I think that you won't be able to purchase an options contract with a strike price like 200, because 200 is too far from 10. So that's how exchange traded options work. Options are divided into classes, like puts on the same asset, calls on the same asset, and all options of the same class which share a common strike or common expiry date, they are grouped into options series. So this is just the terminology. What does a market maker term means? A market participant who quotes both a bid and an offer when asked to do so is called a market maker. So market maker is market participant who is prepared to buy and to sell. Mostly market makers are investment banks, they hedge funds. The individuals don't participate trading as market makers. So why do this notion is important to us? Market makers, the existence of market makers ensures that buy and sell orders will always be executed. So market makers provides liquidity to the market. How do market makers generate profits? Their profit comes from the difference between the bid and the offer. So Russian options market is considered to be illiquid because we don't have many market players who are actively involved into options trading on Russian market. And if you remember these open interest 143, and here open interest is 56. If we talk about Russian markets, it's quite possible that open interest is like 1 or 2 or 5. And we cannot call these markets a liquid market. So take a note, if you'd like to model an option strategy, I think that using Russian options market data is not a good idea, because you will have a very high bid-ask spread in a liquid market, and your options theoretical prices will be different to actual deals prices. So to summarize, market maker and market liquidity are very important notions. If the market is illiquid, no trading, no speculation, no strategies. So during this lecture, we're going to talk about general types of options, but we start with exchange traded equity options, because this is something very basic. Some details. Exchange traded options are not generally adjusted for cash dividends. So, in fact, exchange traded options are standardized, and dividends, there's a certain probability of a dividend to be paid, and there is a certain probability, in fact, uncertain probability that the dividend will be paid, and an uncertain probability that the dividend won't be paid. So standardized contracts cannot be adjusted for something that is uncertain, and that's why they're not adjusted. So when a cash dividend occurs, there are no adjustments to the terms of the option contract. Corporate actions splits, first of all, don't have an effect on exchange traded options, because split is just there was an option with one share underlying. After a split, you have the same price, you have the same everything, because stock split does not affect market capitalization of the company or stock prices. So you will have the same option for a new amount of shares. So I hope that you know what a stock split is, but if you don't, there's a brief info about this corporate action. And I hope you know what a corporate action is. We talk about traded assets. So when we talk about traded assets, secondary public offering, stock split, dividends, buyback, and other actions are important, but it's a bit outside the scope of this course. So if you're unsure that you know all these corporate actions and their role, have a look at any like Investopedia or any source, because it is important to know these notions. As for stock dividends, so there are two types of dividends: cash dividends and stock dividends. If a company announces stock dividends, so some new shares are issued, options are adjusted, but in fact, stock dividends issuing of, so if I have 10 units of stock, a company announces stock dividends, like one new stock for each 10 units of stock. After this corporate action, I will be having 11 stock. But in fact, the earning power of the company or its market value won't change. So, in fact, a stock dividend can be regarded as a stock split. So market capitalization doesn't change. The earning power doesn't change. just the number of stocks that are issued changed. So in this case, the exchange traded option is adjusted for these stock dividends, but in fact, market capitalization of the company doesn't change. So I have mentioned margining. So there is strategy-based margin. The riskier the strategy, the higher is the margin. So in fact, you may try to post your positions separately and attempt to lower your margin, but it might happen that exchange just join your position. So you say that there is a put and there is a call, like two separate positions, but exchange tells you that it is not a put and a call because you have it like a strangle. We're going to talk later about what strangle is. So there is a cash account, there's a margin account. So there's initial margin, maintenance margin, and there's a cash requirement that what is specified by exchange, options exchange. So as there might be strategy-based margin, there is also an instrument-based margining. So if you have, there are two notions, your option can be naked or your option can be covered. Naked option is an option that's not combined with an offsetting position in the underlying asset. So if you write naked pull or write naked call, it means that you sell an instrument, but you sell an option on an instrument, but you don't have these assets. And in case the option goes in the money, you as a premium, the person who received premium, who traded your obligation for a premium, is now have to pay out. So purchase an instrument and give it to an options buyer, or you have to purchase an instrument from an options buyer. So in this case, an instrument-based margining is a principle that a riskier position, the riskier your position is, the higher is the level of margin required by an exchange. So these naked puts and naked calls are considered to be quite risky. Well, the riskier from all positions. And to open a naked option position, you are required to post this amount, maximum of what you can say in parentheses. 100% proceeds of sale plus 20% of underlying price minus an amount by which the option is out of the money compared to 100 proceeds of sale plus 10 proceeds of underlying price. So there is an example. So if you have your questions, please keep your questions till the next slide. So another position that is nearly contrary to a naked option is a covered option. The covered option is an option that is combined with shares, covered call mostly, that might have to be delivered, so your shares are already owned. So if a covered call is out of the money, no margin is required. So if you have an asset and you write down a call, it means that you write down a covered call. If a covered call is in the money, the same thing, no margin is required for options. So can you have a look at this slide carefully, please? Because at the next slide, we are going to have a couple of examples. So I just want you to understand these details. So does anybody know what is calculating an equity position, and why do we need, like, for the purposes of calculating the investor's equity position, but why do we need to calculate this equity position? Any ideas? No ideas and no questions. Okay, so imagine that you trade options. You priced margin and you want to buy some of your assets to be included into your overall position. So I have the Microsoft stock. The Microsoft stock is liquid, and I'd like an exchange to include this liquid stock into an available amount of money that I can use to guarantee my, for example, naked option. So if I have different positions in different options, different terms, and so on, it's very important to calculate my cash and my available cash and available equity in order to get a realistic picture of whether I fulfill margin requirements or not. So my equity position is how much, like, free equity do I have, and how much of this free equity can be used in margining. For example, if I have a covered call on a Microsoft stock and I have so if I have 2 calls on Microsoft stock, and if I have only 1 stock, my equity position is 1 stock. So marginal requirements, I have to fulfill marginal requirement for 1 option, because 1 option will be covered with the stock that I own, One option will be a covered call, another one gonna be a naked call. Any questions? Okay. So here I've got a couple of examples from CBOE, that's Chicago Board of Exchange. So if I have a long put on equity with a 9-month term, lasts until expiration, cash account initial requirement is pay for each put in full. So if I'd like to purchase a long put, I have to pay premium for this put in full at the moment of contract purchase. Margin account initial requirement, the second line. So cash need to be deposited in excess of put cost. So premium is what I pay at contract initiation. The cost of an option is what is calculated during the life of a contract. So it can go cheaper, it can become more expensive. The cost of an option is what is calculated daily. What about maintenance requirements? No requirements. So you don't have to provide any maintenance margin. On the other hand, if we have short call on equity, this is a long put, that's a short call, two different options. So we have the same. We have cash account initial requirement, margin account initial requirement, and maintenance requirement. So as for cash account requirement, we have to deposit online security or escrow receipt. Sale proceeds not released until deposit is made. So it means if you'd like to get premium and take a future obligation, that what a short call is, you have to deposit an online security or escrow receipt. So entering short call on equity might be costly because of this deposit. So before entering the contract, you have to purchase an underlying asset. As for margin account initial requirement, that is maximum of option proceeds plus 20% underlying value less out of the money amount, and minimum of option proceeds plus 10% of underlying value. Underlying value, what is underlying? A stock. What is underlying value? A stock value. How do you get a stock value? It's market price. So this 10% of current market price. What is 100 of option proceeds? What is option proceeds? There's a formula with max from 0, S minus K or K minus S for puts and for calls, that an amount of money you will get if the option gets exercised. This is what this part means. What is out of the money amount? What amount of money will you get if the option is out of the money? So you just need to calculate first How much money would you get if an option is in the money and exercised? What is the underlying value of, so this is a price, the market price of a stock for equity options. How much money would you get if the option gets out of the money? This amount of money. So that looks quite that's like an impressive formula, but in fact it's quite easy. Just 3 basic things. So the same here, you've got maintenance requirements. So all these things, why do I have the slide here? The slide's role is to explain you that is what trading options might be costly means. This is exact amount of money. And in fact, when we have in theory, like no taxes, no trading costs, etc. In real life, we have lots of trading costs. And because of this margin, options are as costly as futures contracts. So in theory, options are cheap, but in practice, options are really costly. And hedging your portfolio with lots of options is a source of this type of hedging is a source of costs. So options offer various types of options. There is a type that is called flex options. It's something in between an OTC and exchange traded options. So they have like an exchange traded options with an opportunity to specify its details. So there is a list of specific option types. It's just a new page in your glossary. So there it says. So we are talking about exchange traded equity options. So stock options, equity options. First, we were talking about exchange traded options, the contract details, about margining, and so on. Now we have a slide that is dedicated to some, let's say, exotic equity options. These exotic equity options are mostly OTC options. So during these lectures, options are grouped by type. So we have already discussed exchange traded options, and now there is another equity options that in fact are not always exchange traded. It's possible that they're exchange traded, but in fact they're quite often they're OTC contracts. So first of all, there exists warrants. They might be equity, they might be exchange traded, they might be OTC. What is a warrant? If a company issues debt, corporate debt, or in other words, a company issues bonds, they might try to attract lenders by offering their lenders an opportunity to become company stockholders. So a warrant in very simple words. Hello guys, I've recently launched a startup and I need 100 US dollars. Could you lend me 100 US dollars, please? No, we wouldn't like to lend money to a startup. But if I offer you a part in my growing business in 5 years, could you lend me some money, please? Okay, if you offer us a part in your fast growing and promising business, we could probably use some money. We could probably lend you some money. So my additional offer, a part in my promising business in 5 years, that is granted to every lender, is a warrant. And don't be confused with this word, because the same name, warrant, have some complex structured products issued by Natixis. In fact, these products they don't have much in common with what I have described. They're called warrants as well, and mathematically they have the same logic. An ownership for a debt holder, but they're not what a classic warrant is. So don't be confused. There is a classic warrant, an option that is linked to a bond, and there is a warrant as a structured product. So there are executive stock options as well. That's motivation, and they cannot be exercised before a specific date. And there are convertible bonds. So these bonds, so corporations try to make their debts more attractive, and this debt can be converted into equity at certain times. So there's specific equity option. There are some other types of equity options, but these 3 types are like the most commonly used. So when stock options are written by a company on its own stock, like warrants or like convertible bonds, the company increases a number of shares outstanding after these options are exercised. So the number of shares outstanding increases, and means that a part of the company that is linked to each share diminishes. So these corporate actions, like issuing convertible bonds, warrants, and so on, affect shares price, market shares. But I think that you have already studied these corporate actions during a financial market course. So now we will start. So we are still considering equity options, and we will dive into valuation. Look, that's what we are going to study, some formulas. So to start valuation, to plunge into formulas, I introduce option value flashcard. That's what we have started at the first lecture. So we have discussed exchange traded options, details. We have discussed some specific types of equity options, and now we're moving to options valuation. So in fact, if we'd like to value any contingent claim, we have to introduce like filtered probability space. We have to introduce stochastic differential equation. We have to solve this stochastic differential equation. We have to introduce strategies as functions, and so on and so forth. But this quantitative approach is quite difficult for understanding, and I do believe that this approach is absolutely impossible for those of you who don't have a strong mathematical background. And this is why in most derivative courses, all these pricing formulas are introduced like some logic without any strong mathematical background. So in fact, these formulas were derived as solutions for stochastic differential equations. And if you'd like to understand all pricing details, you can send me an email and I can get back to you with some books on stochastic calculus. But to read those books, you first need to have a strong mathematical background. Second, you need to be interested in this topic, because writing like 300 pages of formulas is absolutely useless if you are not going to become an options trader or a quant or whoever. So, in simple words, I'm going to derive you some formulas. This is a simplified approach. This is not how these formulas were derived originally, but it works. This approach is enough for those who are planning to work as derivative sales or back office or something, or who's not planning to work with derivatives at all. So, first of all, I have to introduce a notion of intrinsic value of an option. That would we have already seen, that's a maximum of 0 and the value of the option. So that what is called an intrinsic value of an option. This is for a call option and for a put option. So there are European, American, and some other types of option. So if we have a European option, it has a unique exercise date. An American option allows the holder to realize a positive intrinsic value by exercising immediately. So an American option is an option that can be exercised at any date. So first of all, we'd like to find out when it is optimal for the holder of an in-the-money American option to exercise the contract. Why do we investigate these questions? How do these questions arise? We'd like to understand the time value of an option in simple words. If I have a European option, I can exercise this contract at exercise date. That's my only opportunity to exercise the contract. I can sell it and get some money, but I cannot exercise it earlier. On the other hand, there is a contract that is exercisable at any day. And this is a good example to study the time value of an option and to have a look at how its value evolves as time passes. So that's the core. We like to see how the time value of an option evaluates. This question is crucial for any options trader. Like, should I keep the contract or should I exercise the contract? So here we've got basic notions. We denote the current stock price with S sub 0. We use letter K for the strike price. Capital T is the time to expiration. We denote the volatility of the stock price with sigma. R stands for the risk-free rates, and the dividends expected during the life of the option are denoted with an abbreviation div. So here in below, you can see how options prices are correlated with these factors that affect options prices. So could you have a look at the bottom of the slide, please? And if you have any questions regarding these correlations, why and how, don't hesitate to ask me, because I mean that reading aloud these lines is a little bit weird. So as far as you can say, there is no difference, in fact, between European call and American call. And at the same time, there is no difference between European put and American put. So the higher is the price of an underlying stock, the higher is the price of the call option, and the lower is the price of the put option. the higher is the dividend, the lower is the price of the call, and the lower is European and American, and the higher is the price of the put. So I hope you do understand this thing with derivatives and volatility, and I hope you do understand why volatility affects prices of all options type. So all options types. So the higher is the volatility, the higher is the call price, the higher is the put price, because volatility means uncertainty. And option is a product that allows you to trade your future obligation or someone's future obligation for a premium. So if we live in a world that is full of uncertainty or a world of high volatility, the more valuable becomes a contract that lacks any details in the future. So this contract just eliminates uncertainty and becomes more pricey. If the uncertainty is low, nobody needs to trade premium for further obligation, and the contract price decreases. So that's the same thing. So I have added C, capital P for American options, for American option values. Here we've got C and P for European option values. So let's consider upper and lower bands for option prices. First, we'll focus on upper bands of European and American call and put options. So underlying price is an upper band to the call option, right? So call option is an opportunity to call an asset, to buy an asset. It cannot cost more than an asset. So if I have a contract that gives me the right to call or to purchase an asset, I won't pay for this contract a larger amount of money than for an asset itself. If we have a put option, an upper band to the put option is the strike. The put option is the contract that gives me the right to sell at a predetermined price that equals to strike. So if I have an opportunity to sell something for key units of money, I won't pay for a contract that gives me such opportunity more than K units of money. So, and that is why the upper bound of the put option is its strike, and the upper bound to the call option is the underlying price. don't get confused with sub-zero, as we are talking of the moment of the contract initiation, and during the life of the contract, we have to compare a call price with an asset price. So at time t, they're gonna be S sub t. So for European options, if at maturity the option can't be more than K at any time before the maturity, its upper price bound is less or equal to K multiplied by a discount factor. So if I know that a contract at maximum costs K at time t, it is today's maximum value is K discounted from time t to today. If this were not true, an arbitrageur could make riskless profits by writing the option and investing the proceeds of the sale at risk-free interest rates. The same replication of portfolio in no arbitrage approach. So first, we defined upper bounds. Upper bounds for European and American call option, that's the top of the slide. Okay, we now know the upper bound. We know that a call option or a put option cannot cost more than asset in case of a call option and strike in the case of a put option. And its price and its price band is, and put price band is specified with an equality. P is less or equal to K multiplied by discount factor. What about a lower band? So we know the upper band. What about a lower band? Let's consider non-dividend paying stock, like for simplicity, no dividends are paid. And we consider a European call. It is a contract that has a fixed expiration date. The same thing, we consider European call for simplicity. American options, they can be exercised at any point of time, are in fact out of the scope of this course because they require some extended math. So consider a European call. At time t equals to 0, we purchase for minus C minus call premium a call option with a strike K, and we short sell a stock and reinvest the sales proceeds at our risk-free rate. So I'm just trying to replicate an option, same approach that we have already seen. Okay, so I'm trying to build a portfolio that has similar payments on the right hand side and on the left hand side to write equality and to write a price. And that's why I fantasize, that's why I use this buy, short sell, and so on. So at time t equals to maturity equals to capital T, if an asset price is greater than strike, I can execute the option because at time t equals to 0, I purchase the call option. So I'm the buyer, I long the call, I paid premium for a future obligation from my counterparty. So at time t, capital T, at maturity, if an asset price is greater than the strike price, the option is in the money and I execute the option. So I pay minus K to get the stock, to purchase the stock. I close my short position that I opened at time 0 when I short sold the stock. I keep the cash investment. So now look at the bottom of the slide at number 1. Stock price increase. So with yellow, we have what we've got at time t equal to 0. Minus C, I paid premium, plus S sub 0, I sold a stock, I short sold the stock, so I got some money. Minus K multiplied by discount factor, because at time t equals to 0, I didn't have any money, so I needed to borrow. And as soon as I have purchased the call option, I knew that at expiry date, I will get stock for K. So at time t, I get my stock for minus K, and that's why I have minus K here. Why do I have this yellow multiplier? Because I need to bring because I need to account for time value of money. So yellow is t equals to 0, the contract initiation, and that's why I try to bring this red minus K value at time capital T to t equals to 0, and that's why I have to discount. So if a call option premium is less than the difference of proceeds from short selling and this amount of money that exercising an option generates, if the premium is less than this amount of money, the arbitrage profit is possible. So I can just make this combo, like short sell a stock, then execute, then sell this stock for K, and I will just generate profit for nothing. I will be selling the stock to options holder. So the premium is less than this combination. So the one who makes this will just give money for the one who purchases option. But in fact, market participants don't like to give money. And this is why we can say that this amount of money cannot be greater than a premium that is paid for call option. So if we consider another case, what if an asset price is lower than the strike price and the option expires worthless? So in this case, if the option expires worthless, in both cases, we start with purchasing call option, we pay minus C, and short selling is stock, plus stock price at T equals to 0. And the second, the red part, is we have discussed what's going to happen if an asset price is greater than K, the strike price. And now we discuss what going to happen if an asset price as sub T, subcapital T, is less than strike price. So in this case, option expires worthless. We just purchase the stock from the market to close our short position. We pay as sub T for the stock. So consider the second line at the bottom. If the stock price decreases, here we have minus C plus S sub 0. We purchased an option, we paid minus C for the option, and S sub 0, that proceeds from short selling a stock. At expiration, we will receive this amount of money as subcapital T, and we multiply this amount of money and future by discount factor to bring this future value to present. So K and S subcapital T are option intrinsic values at expiration. So if in this case we have the same logic, we build inequality. So if a call option premium is less than the difference between an asset price present value and what we get from operation with stock and future, if this is a profit generating operation, this one, in this case, we can just purchase an option for a small portion of money, then this and just see that this generates profit and this won't generate profit. So we get an option, we'll lose our profit, and someone's just generating profit from nothing. Would you like to purchase an option? If you can generate profit from just short selling a stock and purchasing the stock from the market at time T. Well, no one would like to do so. So look, in this case, we've got a stock price decrease. In this case, we have a stock price increase. And in both cases, we can say that there's what we have on the right-hand side looks like a price limit. So we know that this is lower than this, right? So look, S sub t lower than K, S sub t higher than K. Here we've got K, here we've got S sub t. So we can conclude that this is the minimum of two outcomes. So have a look at these lines once again, please. So imagine that K is like 100. If as a time T is 200. This is initial stock price minus 100 multiplied by discount factor. We've got S sub capital T less than K. K is 100, so let S sub capital T be equals to like 1. Let's have a look. Here we've got S initial minus 1 multiplied by discount factor. S minus 100 multiplied by discount factor. S minus 1 multiplied by discount factor. This is minimum of two outcomes because we have the same S sub 0. Here we reduce S sub 0 by 100 multiplied by something. Here we reduce S sub 0 by 1 multiplied by something. So this is smaller. This is a small, this is small, this is large. So, and that's why if we opt from 2, if we're talking about the lower band, we take the smallest, right? We need the lower band. This might be, this differs, it might be S sub 0 minus 1 multiplied by discount factor or minus 99 multiplied by discount factor. Anyway, this is a lower value than that one. And that's why this one is considered to be a lower band. So once again, we have a logic that we derive a portfolio of different assets, and we derive a lower bound out of two possible outcomes. So here we've got the same thing for put options. So we have to borrow minus B minus S sub 0, because we need to purchase a stock and we need to purchase a put option with strike K. At expiry date, there are two possible outcomes. An asset price is greater than the strike price, or the asset price is lower than the strike price. If the asset price is greater than the strike price, we're not interested in selling an asset for a price that is lower than the market price. So we let the option expire. We sell the stock that we have purchased at time t equals to 0 at the beginning, and we repay the loan. Otherwise, if it is better to exercise the option, if an asset price is lower than the strike price, and we are interested in selling our asset for K units of money, we exercise an option, we sell the stock for K, and we repay the loan that we have borrowed. So consider these two possible outcomes. Minus B minus S sub 0. That's what we have borrowed at time t equals to 0 at the beginning. That's what we have borrowed. And this is what we received. We received S sub capital T, and we multiply our proceeds by a discount factor to bring this future value to a present value. We have the same thing for decreasing stock price, but we receive K as strike units of money, the same we multiply. In the first case, if a put option price is less than a combo of short, so if I borrow and purchase a stock and I sell a stock, if this strategy can generate more money than purchasing a put option, this is an arbitrage opportunity. So some market players purchase a put option, some market players makes this, borrow, purchase a stock, wait till expiry, sell the stock, repay the loan, and get profits. This is an arbitrage because, in fact, the put option implies the same operations, but so if it costs less money, if it brings less money, then this is an arbitrage opportunity. Here is the same thing, the same opportunity, arbitrage opportunity. If we have to select a lower bound, S sub 0 is the same. It has a minus sign. A lower bound is something with a lower part that is discounted, as the SK. K is like 100, S sub T is higher than 100, like 200, minus s sub 0 plus 200 multiplied by something, minus s sub 0 plus 100 multiplied by something. This is the lower bound. So this is a final slide with lower bounds. So you can have a look at this slide, or you can have a break, or you can have both. And after introducing upper and lower bounds, we're going to talk about Foucault parity. So I hope to see you back in 10 minutes. So I hope that everyone has already poured some coffee or tea or something. And we're going to continue with upper and lower bands for option prices. So here you can say lower bands and lower bands adjusted for the impact of dividends. But in fact, we're going to focus on a simple case. So on the left-hand side, we have a premium. So the worst thing that can happen to a purchased option is that this option expires worthless. Or it can generate profit. And here we've got the profit is a maximum of difference between initial asset price, initial stock price, and discounted strike difference between an initial asset price and a discount strike. Here we've got the same with an opposite sign. So why do we need these upper and lower bands? Because it looks a bit ridiculous. Upper band, lower band. Why do we need it? So we use this upper and lower bound in this logic in a put call parity. It's a very important relationship between put price and call price. So call option is an opportunity to purchase an option. Put is an opportunity to sell the same asset. So let's consider two portfolios. Here we have portfolio A. So we have portfolio A. We purchase a call option with a strike K. We pay minus C units of money to purchase a call option. And we deposit the present value of an amount that is equal to the strike. So here we've got K strike multiplied by discount factor to bring its future value to its present value. And we have a portfolio B. We purchase a put option with the same strike. We pay minus P units of money. And we purchase a stock. We have the same end line for both options. So we purchase a stock. Why do we need these two portfolios? So we need these two portfolios just in order to derive a put call parity. There's two theoretical portfolios. In fact, we don't need them. So what's going to happen at expiry dates at time T, capital T? If an asset price is above the strike, we can exercise the option and use cash we receive as subcapital T units of money. So now we have the stock. And as for portfolio B, we have a put option with a strike equals to K. Asset is traded above the strike level. So we have a stock, but we wouldn't like to sell it. We are going to keep the stock. So the first portfolio, we have a call option and we have an opportunity to purchase a stock, and we have an amount of money that at time t gonna be equal to K. So I purchase a contract that gives me the right to purchase an asset. To purchase an asset, I need some money at time t to purchase this asset. So I deposit a present value. Today, I deposit present value of an amount of money that will be needed at time t, at expiry. So the portfolio B is when I purchase a put option, I pay for an opportunity to sell the stock and to get K units of money. I have the stock, this is my portfolio, I have the stock, and I can sell this stock. So if this stock price is above the strike level, the first portfolio, the call and cash, results in purchasing a stock. I pay K units of money and I get something that costs S subcapital T. This is something greater than K. As for the second portfolio, I'm not willing to sell. Like imagine that asset price is 150 and the strike is 100. I pay 100 and I get from the market something that costs 150. Nice deal. Here, I'm not willing to execute a put option. I'm not willing to sell my stock for K units of money for 100 because its market price is 150 and I keep the stock. If S sub T is less than K, so the stock price is 50 while the strike is 100, I let the option expire. I'm not willing to purchase something for 100 while its market price is 50. So I just keep the deposit. I keep my K units of money. As for portfolio B, I have an opportunity to sell something for 100 while its market price is 50. Nice deal. And I execute the option. So in this case, I have K units of money, 100. So in this case, that's just more details. The same thing. So if my portfolios, let's have a look once again here. This is portfolio A. This is portfolio B. This is portfolio A. this is portfolio B. So I have two different cases, but in each, portfolio A and portfolio B have the same values. So I have two different portfolios. One is a call and cash that equals to a strike price. Another one is a put and a stock. We can consider cash as a bond, for example, because it pays me risk-free rate, and that's why I can say that this is a risk-free rate bond. So I have two different portfolios, but they have identical results. If I have two different portfolios, but they have identical results, I can, if my future values of two portfolios are equal, it implies that present values of these portfolios are equals as well. So this is call option plus cash paying risk-free rate or risk-free rate bonds. And this is portfolio B, put option, and a stock. So I have two present values that are equal. So I'm sorry, just give me 1 second, please. So sorry, I'm back. So this, what you can say here, is called a put-call parity, and this put-call parity allows you to derive a put of call, or a price of a put option or a call option. It can help you to derive a price of a put option or a call option if you have if you know the strike, if you know the initial asset price and risk-free rate, and if you know one of two, whether call or put. So as for this put call parity holds for European call and European put options. As for American options on a non-dividend paying stock, we can have an estimate. We don't have a parity, but we have this estimate, this inequality. We're not going to derive this inequality here. With this, you can have a look at John C. Hall book that's given in reference, and you can find this derivation of this inequality. And we can adjust the put-call parity for dividends, so that for a dividend, and this what we have for dividend paying stock. And we can have the same adjustment for American option on dividend paying stock. But in fact, we can focus on the first line on a classic put-call parity, European option, non-dividend paying stock. Why this put-call parity is important? It holds for put and call prices, because we know asset price, the strike is known as well. So this can help us to estimate put price when the call price is known, or vice versa. What is important? According to the Foucault parity, but we have derived this Foucault parity for European option, and this is an estimate for an American option. First, we can say that it's never optimal to exercise an American call option on a non-dividend stock, on a non-dividend paying stock before the expiration date. So we can exercise an option earlier and keep the stock till the expiration date. We can exercise an option at the expiration date, or we can exercise an option earlier. We can sell the stock and reinvest the proceeds. So we won't consider the reinvestment strategy. We have to compare these two, the first and the second strategy. So keep the option, keep an option, or keep a stock. Because the third strategy depends on risk-free rates, reinvestment opportunities. And basically, when we say reinvest, well, no one knows the rate. If you have, for example, a venture capital project, high risk, high potential yield, it would be difficult to compare a venture investment with an option trade. So we're not going to consider the third strategy. As for the first and the second strategy, should we exercise an option earlier and keep the stock, or should we keep an option? What is better? What is more profitable? So consider the first strategy. We like to exercise an option earlier, and we like to keep the stock. We have key units of money paid before the expiration. So the interest are key for this period of time while we are waiting till the expiry. We're keeping the stock, right? We're keeping the stock. So we don't earn interest for this period of time that lasts from option expiry and the date we exercise the option. So the call option, when held instead of the stock, ensures the holder against the stock price falling below the exercise price. So if I keep the stock, it might happen that its price will decrease, right? And if this price drops down, I won't exercise the option. I will keep money. If I exercise earlier, I will lose money, right? So keeping an option might be regarded as a sort of insurance against the stock price drop. Once again, this is the case when I'm going to keep the stock. I'm not going to reinvest the sales proceeds into any other business. If I exercise an option at expiry, I pay the key amount of money later, and I have an interest on this amount of money. So my money just stays where they were and I continue earning interest on this K amount of money. And if we consider a non-dividend paying stock, I don't expect any income from the stock. So I have a kind of insurance from the stock price drop. The third strategy, the reinvestment. We just don't consider this strategy because we don't know about any other investment opportunities. Like I'd like to exercise the option and I'd like to open a grocery, for example. It's very difficult to compare a grocery or startup with an option strategy, and that's why we just don't consider it. So if the investor thinks that the stock is overpriced, probably it would be better to exercise the option, right? So I believe that the stock is overpriced. I think that I can exercise the option and I'll get some more money for the stock. But if I'm not going to sell the stock, it's better selling the option than exercising the option. Because if the option is liquid, if there are some other investments and they share my belief that the stock is overpriced, the option will be bought by another investor who doesn't want to have the stock. And why do we believe that such investors exist? Why do we believe that someone would like to purchase the option? Well, if such investors does not exist, the current stock price would be lower than the one we say. So the price obtained for the option will be greater than its intrinsic value. So this logic might be a bit complicated, but I try to make it as simple as possible. So where there are two strategies, I can exercise an option or I can keep it. And we derive that exercising an option is a better strategy than is not a better strategy than keeping it. So we can keep an option till the expiry date, or we can sell an option. And the worst strategy, the last profitable one, is exercising.
Excuse me, we have no sound.
What about now? Is it better? Yes, good. So
Yes.
that this topic is really difficult, and I wanted to have a look at these slides once again as soon as you work with them at home. So the most common question, I highlighted it with green. Why, if the investor thinks the stock is overpriced, the investor is better off selling the option than exercising it? So look, the owner of an American call has all the exercise opportunities open to the owner of a corresponding European call, right? So European call owner has a fixed date, while American call owner has a range of dates, like any dates. As soon as we have defined upper and lower boundaries, we can say that call option price is greater than maximum of greater or equal than the maximum of this. And the call option price is greater or equal to the difference between the stock price and a present value of the strike amount of money for an option in the money. So for an American option, we determine is with capital C. We can say at least the same. So American call is more flexible than a European one. That's why its price is greater than a European call price. If we know that for European call, this inequality stands this inequality, it must be the same inequality for the price of an American call. Given our interest rate is greater than 0, this K multiplied by discount factor compared to K without any discount factors, this K is greater than K multiplied by discount factor. If we consider a difference, this is a small amount of money, this is a bigger amount of money. If we subtract from S sub 0 a small amount of money, and we subtract from S0 a greater amount of money, we can say for sure that this is bigger than this, subtracting a small amount of money or subtracting a big amount of money. So this is smaller than this. And that's why we can say that an American call price is greater or equal to this difference between initial stock price and the strike price. If it were optimal to exercise early, the price would be just equal to the difference, right? But we don't have
an equality. We have inequality. And here we can see on graph, this is an asset price, this is a call option price, this is the strike level, and this is what is given by an equality, the red line. So this graph shows the general way in which the call price varies with asset price. And here is, we can see strike price here. So the call price is always above the intrinsic value. So are there any questions regarding this graph and these inequalities and everything else? Okay. So here I've got the same reasoning, a text reasoning. For those of you who better deal with words and logic when there's with inequalities and some small formulas. So a call option, when held instead of the stock, ensures the holder against the stock price decrease. Once the option has been exercised, the insurance vanishes. The other reason is the time value of money. The later the strike price is paid, the better. If we consider dividends, we can no longer assert that an American call option will not be exercised early. And sometimes it is optimal to exercise an American call immediately prior to the next dividend date. So just to, the ex-dividend date is the last date when the stock trades without its dividend. So sometimes it is optimal to exercise an option to get the stock and to get dividends. But it's the only day when it might be profitable to exercise the option. So consider an American put option on an earned dividend paying stock. We'll show you that at any time t that is taken within the interval between the contract initiation and contract expiry, it should always be exercised early if it is sufficient deep in the money. So we have just discussed a call option, and we derived that it is never optimal to exercise an American call option before expiry. If you don't have any amazing startup to invest in or something, or you just need money here and now. And now we're going to consider an American put option, and we're gonna prove the opposite. It should always be exercised early if it is sufficiently deep in the money. Well, in fact, this is something like obvious. Why do I say that this is something obvious? Because, in fact, put's profit is limited. You won't be able to get more. Put is it's an insurance of the price dropper. It can be considered an insurance from the price drop. But the premium, the profit of a put is always limited. well, call profit is unlimited. So the early exercise of a put option as attractive as lower the asset price, or the put exercise is more attractive as interest rates increases and as the volatility decreases. So you can explain to yourself these dependencies quite easy. So consider a price of a premium for a put option. We have already derived these this inequality while we were deriving lower and upper boundaries for putting call options. So we know that the price of a put option is greater or equal to the difference between an initial asset price and the discounted strike value for an option in the money. And for an American option, we have a stronger condition, and we derive the stronger condition the same way as we derived it for a call option. And we can have that an American put is greater or equal to the difference. So here we've got discounted difference. A difference, well, one part of it is discounted. Here we've got no discount, stronger condition. So here we've got the same graph. Here we've got, I will correct this mistake. There shouldn't be C, there should be letter P for a put option. So there is a put option price, and this is an asset price. Here we denote with red a K strike level. So this is the value of a put. And we can see these green arrows, that's the price of a put option, tend to move upwards. So for a sufficiently small value of an underlying asset, we have this point. So here is the price, here is 0, and this is sufficiently small value. And it is the early exercise is optimal when the value of option is K minus S of 0. So as far as you can see, as the price of an underlying asset gets closer to 0, the closer to 0 the price is, the more profitable it is exercising a put option. These green arrows shows us the way the put price moves when interest rate decreases, or when volatility increases, or when time, the contract length increases. So the longer the time of the contract, the more expensive is the option. The higher is volatility, the higher is uncertainty, the higher is the price for locking any conditions, for the higher is the price of eliminating this uncertainty. When R decreases, the lower is the interest rate, the higher is the price of a put option, because high interest rates implies higher a smaller discount factor, and the higher is the price. So this is the discount factor. If we have we have these inequality, so we have lower R, the lower is the R, the smaller is this part, the bigger is the smaller is this part. So you can have a look at these formulas once again and derive why R is inversely linked to a put price. So here we've got one of the final slides in this part. So the same things given in words, not in inequalities or so. So there are several circumstances when it is desirable to exercise an American put option earlier. And American put option is always worth more than corresponding to the similar European put option, because American put option is more flexible, and you can say the equality sign at expiry dates when they become the same contract. So the main thing that you have to bear in mind, first, a put call parity. Second, hold call option. Don't exercise it early. Sell it if you believe that the stock is currently overpriced. Your profit can be greater than from an operation with the stock itself. If you have a put option, exercise it as soon as your option is sufficiently in the money. Put call parity was derived from lower and upper boundaries of options prices, and in fact, European options and American options have their lower and upper price boundaries. American option is always more expensive than a European option because it offers a wider range of exercise date and is more flexible. So this is a summary. If you need to keep in mind, as for the rest is needed to solve some home task. So I hope that this our home task is linked to our slides. I did my best to link the home task to the slides. So now we're moving to options trading strategies. So this part of our lecture is easier. In fact, it doesn't require that much formulas and so on. So first of all, there's a positions basis like basic terms, and so on. So can you tell me, please, whether the sound outside, the sound of some sowing trees is really difficult to um, to deal with, or it's just fine? Or it's just me who can hear this sound? Okay, so if it's just me, all's good. Okay, so this is, here you can see some basic terms. We have already discussed these issues, these terms, but I just need to put them on the slide to remember. So yeah, we have a synthetic long asset. So this is a very basic position, synthetic long asset. So when investor buys a call or pays premium for the right to buy and writes a put, so gets a premium for an obligation to buy. These both options have the same expiration date and the same exercise price. This position is equal to having an asset. I have the right to buy and I have an obligation to buy, right? The right to buy and obligation to buy. I can exercise my right to buy to get the asset, and someone exercises their right to buy, their right to sell an asset. So I take an obligation to buy. So someone has the right to sell an asset to me. There's two contracts, long call and short put, altogether combines a synthetic long asset. So have a look at this slide carefully, because this is the first position. It's very important for you to just understand what's going on. So is that clear? I mean, do you have any questions regarding this building a synthetic long asset, or it's like clear? I mean that if we go through this slide and if you tell me that everything is quite clear, we can just move forward. This is clear. Okay, thank you. So I'm sorry, there's something like oh, I've lost electricity. Just a second. My apologies. I have suddenly my computer turned off. So can you see slides? Because I can't log in at Zoom at my laptop. There's something wrong with it. So here we had basic positions. So the same way we can build synthetic put and synthetic call, but these positions are not actually widespread. So they were popular like in 1973 when derivatives trading and this dealing with derivatives has just started. So in the current days, the positions are not really popular, but imagine that the first synthetic put or synthetic call were introduced like 50 years ago. It's 50 years ago. First traders who worked with derivatives or retards people now, like in their 70s or 80s, that the first traders, they're now 80 years like that. And at the Soviet Union, former Soviet Union traders that were resided in London, they were like brilliant sources of income. Traders were well traders and we had like an insight about some political events and crises and so on. And at that time in the UK, where these traders resided, they were like source of market info. So if a Soviet trader sells, it was like a sell signal. Like this trader knows something that the market does not know. So at that time, it was quite different from the reality we have today, and this was mostly insight based. What else? You have and you sell a call option. Getting some of the line to buy. There is a protective put. So you purchase like an insurance. This product protects you from losses in the value of an underlying asset. So who needs protective puts? Those who need insurance need protective puts. It's quite simple. And who needs covered calls? So sometimes investors write options to get premium and they consider these premiums as an additional source of income. So it might happen that an investor owns an asset, and investor believes that the price of an asset is likely to remain relatively flat over a certain period of time. And investor believes that he could write a call option to receive a premium. So if an asset price increases, in this case, he has this asset. So this is a backed position. In fact, the trade-off between the size of the option premium and the likelihood of option exercise is straightforward. If market believes that the event that is an underlying of an option is likely to happen, the premium gonna be low. If they believe that the event, so if I know for sure that an asset gonna cost like 100, that's like a fact, and the price is 99, who would pay a great amount of money to purchase an option that gives the right to purchase an asset for 100? Like, we all believe that the price of an asset is going to be 100 tomorrow. What for do I need an option? The same thing is that I believe that an event is somehow unrealistic. Today's asset price is $1. What's the price of an option with a strike 1,000? Well, first of all, a strike of 1,000 just does not exist if we talk about exchange traded options. But even if this option existed, its price would be like zero. Zero probability of these events. So so the greater premium is paid when market believes that it's quite possible for the option to move in the money. So there is a possibility. If the market is sure about something, or the market believes that something is impossible, we cannot talk about any options trading strategy. There's any premiums. So we can consider the option premium as income, and it is important to remember that the call writer has given up the most desirable part of the expected return distribution. So if I write a call, I cap my expected income. I won't get any profit from an asset price rise. So why do we write covered calls? It might happen, a very realistic strategy, it might happen that I have an overweight in a particular sector, like energy or telecom or whatever. And if I'd like to reduce this imbalance, I can write covered calls. So if covered calls gonna get executed, that's fine. I'll just use this forced sale as a mean of rebalancing. Like I would like to sell these assets anyway, because I'd like to reduce my exposure to certain sector or economy or currency or something. And if these options won't get executed, okay, no problem, I just keep the premiums. So it might be useful when you have a large portfolio, a diversified portfolio, and you feel like you need to diversify it more. So just to reduce exposure to certain sector or something. There might be a strategy that's called like target price realization. So I believe that I'd like to sell these particular assets at a predetermined price. And if this price is equal to the strike of a covered call, it means that I'm just getting premium for selling assets at the price, a desired price. So this is the way how I can get rid of assets at predetermined price. It might happen in this case when I do believe that in a long term, the asset will probably decrease in value, significantly decrease in value. And I might use this strategy to sell at predetermined price. So here you've got some small formulas for a covered call and protective put, the maximum profit, maximum loss, break-even point, profit expiration, and expiration value. Because these formulas are very simple indeed, because covered call is what you get from call and asset, and put is what you get from simple put and asset. And there's just a linear sum of having an asset and having a put. There's nothing different. And basically all the rest options, strategies and combinations are built according to the same principle. It's just a linear sum, algebraic sum. What else do we have here? We have a position that is called a collar. Long an asset, long put, short a call. So this, you can just have to understand each strategy. First, you have to have a look at maximum profit, maximum loss, and you just get what you, maximum profit, maximum loss, value at expiration. So I have an asset. I get premium from selling a call, from writing a call, and I pay this premium to long a put. What's the profit? These collars allow shareholder to acquire downside protection. So I have a protective put, and if the price is going to go down, I've got a sort of an insurance. If I'm lucky and if I carefully select options, the strike prices and the strikes, I can offset the insurance premium that I pay and the call premium I receive. So I have an asset, and I believe that and I believe that the asset can remain at the current level or even go down. And I purchase an insurance, and I pay for an insurance. To offset this payment, I might sell It can be covered call, and it might happen that these premiums offset what I've paid for an insurance. That's right, regardless of the stock price. Is worth the ultimate effect. So there's no risk. The position protects me from a decline in market value. Because long put and short call is a synthetic short. We have discussed it during the previous slides. So in fact, I have a long position and short position. In fact, I have a neutral position. So if we scroll one of the previous slides, you're gonna see that we have already discussed that long put and short call is synthetic short. So here we can have a look at options-based positions offered by the Chicago Board of Exchange. There are three different positions or strategies. What is called a spread is a combination when an investor buys one call and writes another, or buys one put and writes another. What is called a combination? A combination is something that is built out of puts and calls. So spread is calls, and calls, or puts, and puts. Combo is when you have both puts and calls. So we have a bull spread, we have a bear spread, and bull spread is, I believe that the asset price is gonna go up. Bear spread is when I believe an asset price is gonna go down. And spreads are classified by the direction of the initial cash flows. If it requires a payment, it is a debit spread. If the spread results in a cash inflow, this is a credit spread. So there are lots of spreads in this presentation, and mostly are given like for info, and you can study these spreads on your own. And we're going to focus on both spread and bear spread. So we have just 6 slides remaining, and the rest is on your own reading. So here is the image. That's how it works. You buy one option and you write another one with a higher exercise price. A call price always decreases as the strike price increases. The value of the option sold is always less than the value of the option bought. So this spread is used when I believe that the price is expected to rise. So as you can see, the profit is limited, the loss is limited. The dashed lines is my options, and a solid line is a resulting bull spread payoff, bull spread profit. So the loss is limited, the profit is limited, and I get the maximum profit at when the asset price is equal to K2, the strike of a second option. So this is a very strategy. So there are variations of those depending on whether calls are out of the money or in the money. So it is quite possible to purchase a contract when it is out of the money. Okay. That's the difference in the price in contract. This every kind first you need to consider profit graph. And after you have a look at graph, well, everything is important. So here we've got the graph. Once again. And those graphs also they created by buying a put with a low strike and selling a put with a high strike price. So here we can see the same resulting solid line, the same resulting profits, same resulting payoff, but it is built out of two different options. So, unlike the bill spread created from calls, bill spread created from puts involve a positive cash flow to the investor upfront. And the payoff is either negative or zero. So there are many nuances regarding these spreads and these positions, because you need to consider options liquidity. As far as you remember from the first slide, the calls are more liquid than puts. Calls sometimes whether you build a spread out of calls or you build a spread out of puts depends on various number of like technical factors. I mean, you can build your spread out of what is available and what is affordable. Availability and let's say affordability is these two things need to be considered as well. So in our final group of slides for today is a bear spread. A bear spread, as far as you can see from the program, is something that works as an insurance when an asset price decreases. So if you look when an asset price is low, it generates profit, but as the asset price increases and as we proceed to the right, we can say declining profit, but the loss that is generated with this position. So like a classic bear strategy, it's a strategy for an investor who believes that the stock price will decrease. So bear spread can be created from calls. That's what you can see on the slide. So the dashed lines represent two calls. One call is purchased, one call is sold. Two different strikes. And a bear spread created from calls involves an initial cash inflow, because as far as you can see, the premium paid is higher than the premium received. number plus limit both the outside topics and topics. The same way they can X instead of false. So the rest of this lecture is something that you won't see in your this is it. Give you any tasks on like strangle or straddle at this combinations. And so this is all for today. I hope you'll have a look at these. Since regarding what we have discussed today. Okay, so I'm happy that you don't have any questions. So if we have like a limit of time, I think it would be better to discuss something from the end one next time, because our next time lecture is a bit shorter. So if you have any questions, don't hesitate to send me emails. So thank you. Have a nice weekend, and you will receive a new quiz today, but as for dates, it will be extended. You will have some more days, like till next Wednesday, because your previous course ends on Wednesday. So have a nice weekend. Have a nice Saturday.